The Department for Work and Pensions has been underpaying state pensions for decades, not to a handful of people, to hundreds of thousands of people. Mostly women, mostly quietly, and mostly without anyone ever telling them. One woman received £8,800 in backdated payments when the error was discovered. Another received nearly £5,000 plus interest. A third is still waiting because the DWP has acknowledged the problem but has not yet reviewed every case. And those are just the people who found out through a campaign. There are others, right now, today, who are receiving less than they are legally owed and have no idea. But underpayment by the DWP is only one part of this story, because millions more people are not receiving the full state pension for a different reason entirely. Not because the government made a mistake, because they made choices, career breaks, part-time years, time out for family, that created gaps in their national insurance record. And because nobody ever told them those gaps were fixable. In this video, I am going to show you every way the state pension can be shortchanged and every specific action that gets it back. Not vague advice, exact steps, the phone numbers, the forms, the deadlines. And by the time we are done, you will know more about protecting your state pension entitlement than most people will ever find out. Stay with me, because the fourth thing I am going to cover is one that most people have genuinely never heard of. It is free, it requires no contributions at all, and it is sitting unclaimed by thousands of grandparents across the UK right now. Let me start with the number that matters before anything else. The full new state pension from April 2026 is £241.30 per week. That is £12,547 per year, for life, inflation protected through the triple lock every single April. If you had to replace that income privately, if you walked into an insurance company and asked them to pay you £12,547 per year for life, fully protected against inflation, they would charge you somewhere between £200,000 and £250,000 for the annuity. That is what this entitlement is actually worth as a capital asset. Every single week you are underpaid is not just a few pounds, it is a deduction from a £200,000 asset that you spent your working life building. And every year that underpayment goes uncorrected, the gap compounds. That is the number I want you to hold in your mind as we go through the rest of this video, because the actions I am about to describe are not administrative tidying up, they are worth real money, in some cases thousands of pounds, to the people who take them. Let me cover the DWP underpayment scandal first, because if you or someone you know falls into any of these categories, checking for underpayment is the highest priority action in this video. The underpayments primarily affect women on the old state pension, those who reached state pension age before the 6th of April 2016. The specific groups most at risk are married women, widows, and divorced women. Married women on the old system could claim a state pension based on their husband's national insurance record, typically at 60% of the basic state pension. But the DWP failed to automatically uprate many of these women's pensions when they became entitled to the higher rate. The system relied on manual processes, and those processes failed on a large scale. Widows were affected in a similar way. When a husband died, his widow should have had her pension reviewed and potentially increased to reflect his contribution record. In thousands of cases, that review either did not happen or was processed incorrectly. Divorcees whose ex-husband had died were also entitled to uplift in some circumstances, and in many cases that uplift was never applied. The government's own figures initially estimated 137,000 women were affected. That figure was later revised to 237,000. And the National Audit Office noted the full extent would not be known until every case had been reviewed. If you are a woman on the old state pension, or if you have a parent or relative who is, and any of those circumstances apply, the action is to call the pension service directly on 0800 731 0469 and ask them to review the pension entitlement. Do not wait for a letter. The DWP is working through cases, but proactive contact almost always moves faster than waiting in a queue. Now let me turn to the gaps. The reason most people of working age are not on track for the full state pension. You need 35 qualifying years of national insurance contributions or credits for the full £241 per week. Fewer than 35 qualifying years means a proportionally reduced payment. And the 6-year window to fill past gaps is moving forward every April. A gap year from the 2019 to 2020 tax year is already outside the standard 6-year window. Every year you delay is a year you can no longer correct. But before I get to the cost of filling gaps, I want to make sure you understand something that is frequently missed. Not every shortfall requires you to spend a penny. There are national insurance credits, free qualifying years that are awarded automatically in certain circumstances, that many people are simply not claiming. Here is who qualifies for free national insurance credits right now. Anyone claiming child benefit for a child under 12 receives national insurance credits automatically. But here is where this gets important. If child benefit is claimed in the name of the higher earning partner rather than the stay-at-home parent, the credits go to the wrong person. The carer gets nothing toward their state pension for those years. To fix this, child benefit can be transferred into the carer's name, even going back to 2013 in some circumstances, and the credits can be applied retrospectively to the carer's record. This affects hundreds of thousands of women who stepped back from work to raise children while their partner remained the higher earner. Carers providing at least 20 hours of unpaid care per week for someone receiving certain disability benefits may qualify for carers credits, free national insurance qualifying years at no cost, added to their record each year they continue caring. People claiming job seekers allowance, universal credit, or employment and support allowance in certain categories receive credits automatically during the claim. And people who took time out for approved training in some circumstances may also qualify. Check the gov.uk National Insurance Credits page, I have linked it in the description, and go through every category carefully. There may be free qualifying years sitting unclaimed on your record right now. Now, here is the one that most people have never heard of, and I promised you this earlier in the video, so here it is. Specified adult childcare credits. If you are a grandparent or any other family member who looks after a child under 12 while the child's parent goes back to work, you may be entitled to have the parent's national insurance credits transferred to you. Here is how it works. The parent claims child benefit and therefore earns a national insurance credit for that year. But if the parent is working and paying national insurance through their employment, that credit is surplus to their needs. They are already building a qualifying year through their earnings. The credit can instead be transferred to the grandparent or other carer who provided the childcare. The grandparent does not need to be claiming anything. They do not need to be registered as a carer. They simply need to apply, and the application can cover multiple past years, going back to 2011. For a grandparent in their late 50s with gaps in their national insurance record, a few years of specified adult childcare credits could add £1,000 to £2,000 per year in additional state pension income permanently, at no cost whatsoever. The form is called CF411A. It is available on gov.uk. Both the parent and the grandparent need to sign it, and it needs to be submitted before the end of the tax year in which the care took place, so past years can be claimed, but only within that limit. If you are a grandparent looking after grandchildren while their parents work, this is the most valuable 5 minutes of form filling you may ever do. I have linked the form in the description. Now let us look at the paid option, buying back missing qualifying years, and the maths that make it one of the best financial decisions available to most UK adults. Each additional qualifying year adds approximately £6.89 per week to your state pension. That is £241.30 divided by 35 qualifying years. Over a year, that is £358 of additional pension income. The cost of buying a Class 3 voluntary national insurance qualifying year is currently £824.20. Divide cost by annual return. Your payback period is 2 years and 4 months. On a 20-year retirement, a single gap year that costs £824.20 to fill returns approximately £7,160 in additional state pension income, before triple lock increases that will grow that figure in real terms every single year. If you have 3 gap years that are all fillable and would each increase your forecast, you spend £2,472.62. Over 20 years, you receive over £21,000 in additional income. 2 critical points before you pay a single penny. First, call the Future Pension Centre on 0800 731 0175 before paying. Not every gap year will increase your forecast. If you already have 35 or more qualifying years, additional years make no difference. If your forecast is reduced by the contracted out deduction, which I will explain in a moment, the calculation is different. HMRC will tell you precisely which specific gap years, if filled, would actually increase your payment. Only pay for the years that move the number. Second, check whether Class 2 rates apply to you. If any of your gap years fall within a period of self-employment, even with modest profits, you may qualify for Class 2 voluntary contributions at just £3.45 per week, rather than £17.45 per week for Class 3. That is a dramatically cheaper rate for the same qualifying year. Always ask HMRC which class applies to each specific year before paying. There is one more thing I want to cover, the contracted out trap, because it catches people who believe they have plenty of qualifying years and are therefore completely fine. If you worked for an employer that ran a defined benefit or final salary pension scheme between 1978 and 2016, there is a significant chance you were contracted out of the additional state pension during some or all of that period. Being contracted out meant you and your employer paid lower national insurance contributions. When the new state pension launched in 2016, HMRC calculated a starting amount for everyone. If you were contracted out for a long period, your starting amount may have been reduced, even if you have 35 or more qualifying years on paper. This means you can look at your national insurance record, count 38 qualifying years, feel reassured, and still be receiving a state pension below the full amount. The year count is fine. The contracted out deduction is the problem. The way to check this is through your state pension forecast on gov.uk. If your forecast is below £241.30 per week, despite having 35 or more qualifying years, contracting out is almost certainly why. Call the Future Pension Centre and ask them to explain your starting amount calculation. They can tell you whether additional qualifying years would increase your forecast from that point, or whether the contracted out deduction is fixed. Let me give you the complete action plan. Everything in one place. If you are on the old state pension and you are a married woman, widow, or divorcee, call the pension service on 0800 731 0469 this week and ask them to review your entitlement. Do not wait for the DWP to contact you. If you are a grandparent providing childcare, complete Form CF411A immediately. Check how many past years you can claim. This is free money, and most people claiming it have genuinely never heard of it. If you took career breaks for caring responsibilities, check whether child benefit was claimed in your name. If it was claimed by your partner, contact HMRC to investigate whether credits can be transferred retrospectively. Check your state pension forecast right now on gov.uk. Log in with your Government Gateway account. Note your forecast, your qualifying years, and every gap on your record. Call the Future Pension Centre on 0800 731 0175. Ask them which specific gap years would increase your forecast and what each one costs. Only pay after that conversation. And if you have gap years from a period of self-employment, ask specifically about Class 2 rates, the cheaper option many people never get offered unless they ask. The Retirement Ready UK State Pension Optimizer shows you how different state pension amounts, including the impact of filling gaps, interact with your full retirement income picture. It models the lifetime value of topping up specific gap years alongside your SIP drawdown and ISA savings. Link is in the description. The state pension is worth £200,000 as a private annuity equivalent. It is inflation protected for life, and a significant number of the people watching this video are either receiving less than they are owed or are on track to receive less than they could through gaps that are still fixable, credits that are unclaimed, or underpayments that the DWP has not yet corrected. Do not leave this to chance. Check your forecast today. It takes 5 minutes. Make the calls, fill the forms. The deadlines are real, and the window closes every April. Hit like if this was useful, subscribe for more UK retirement planning content in plain English. I will see you in the next one.